Well, welcome. We're going to start here in a couple of minutes. I know we've got a lot of people filing in here. Ryan, you nailed the estimate in terms of how many people attended. Portion of those registered. Are you going to go with the same number this week?
Maybe a little bit lower, since I think the total registrations is a little bit lower. And like we've talked about, the proportion is very consistent. So we'll see, maybe 145, 140 this week.
Welcome, welcome. Before we get started here in a minute or two, many of you who have attended these in the past know we always do the very technical tech check by, can you hear us and see the screen? So if you maybe just raise your hand there in the Zoom thing. Excellent. People raising their hands before I even ask them to raise their hands, so that's very good. Thank you, thank you, thank you. Right at 12:02 Eastern. Hope everybody's having a good day so far. We had a pretty big surge in the number of registrants since last week, which can either mean that people were just so moved by the tax esoterica that we discussed last week that they got very excited and told others to attend this life-altering webinar. But actually, I thought it went quite well. And a couple things here before we get formally started. As many of you know, we will send out the free webinar link probably toward the end of this week, first part of next. We do not send out slides. It's part of the free link in terms of the recording. And also, we'll probably mention this one or two more times too, is we really do hope that this will be more interactive perhaps than some of our past webinars, because while we're talking about the top 10 questions that are a little bit black and white to some extent, myths, which maybe are to some extent true and some extent not true, and mysteries, which are still mysteries to Ryan and myself too. So there'll be a lot of, and I know there are a lot of very sophisticated, experienced people on the phone here today, and so we'd love to have that in the Q&A in particular, or in the chat. So we'd like this again to be more interactive than the past. So with that, I'll formally start. So Brian Klontz with Charitable Solutions. Got my partner Ryan Raffin, who will be leading most all the discussion today. I'll be more of the lurker, helping with chat questions and then adding random commentary. And so all these are part of our monthly free webinar series. I can't remember how long we've been doing this. I think about 2 years. It's got to be pretty close. And I think we have that list of all the past webinars on the final slide too. So Ryan will get to that toward the end. And so you can see we're talking about the Form 8283 and 8282. And there are, to me, in fact, even today, Ryan and I talked about a thing like, I just am sure this is correct. It's like, well, it's kind of correct, but here's the other issue. So we deal with a couple hundred of these, actually more than that on the appraisal side, probably 300 to 400 8283s and 8282s as well each year. And we still have all kinds of questions about them. So with that, Ryan, maybe we can just jump ahead here. I'm going to do a brief overview of sort of who we are, what we do from Charitable Solutions standpoint. So a little mini ad. I've done historically a poor job of sort of explaining all the weird things. And so we currently work with about 340 to 400 or so clients across all kinds of different services. But the main thing you can see there is the mission, which is to help make charitable gifts happen that otherwise wouldn't. We do that through risk management, structure, and aggregation. And so sort of that top right, Emergency Assistance Fund Administration. I set up a charity about 10 years ago, the Emergency Assistance Foundation. We provide grants, usually tax-free grants, for generally employee groups where employers establish the funds, then they're tax deductible, making contributions into the funds, and then based on our independent third-party review, vetting of the grant applications, subject to the criteria for personal hardships and for disaster relief, we're able to make grants to their charitable class, usually their employees, globally. And so you can see there we've got about 350 now, very large fund sponsors. The average group we work with is about 30,000, so they're quite large, and we've done, I think, now almost 20,000 grants just into Ukraine in the last couple of months. We did over 200,000 grants for COVID. So it's been a lot sort of on that time. We've got a team of about 150 or so on sort of that side of things that we do, but much less relevant what we're talking about today. Bottom right is professional advisor CE, as well as training for board staff. You can see nonprofit speeches, conferences, things like that. Doing usually about 1 to 2 of those a week, sort of separate from our webinar series. I am very happy to see that that's sort of coming back more in person, so I'll be in Kansas City on Thursday. And that's about half and half now in terms of our training CE delivery, both in terms of virtual versus in person. So I'm selfishly hoping that stays about 50-50, which would be about right. So I like getting out and seeing people to a point. And about half the time I don't want to see people, and I'd rather do it virtually. So we'll see how that goes. Then sort of bottom middle, what we're talking about today a bit is the charitable appraisal piece. So we have a team now of 5 appraisers, and the quick tagline is, if it can be donated to charity, we can appraise it. So we did our first non-fungible token appraisals, did 4 of those about a month and a half ago, I guess, in that range. I think we got a cell tower lease appraisal that popped up yesterday. I'm doing about 6 to 8 a day through tax season on crypto side. Life insurance appraisals, business appraisals. We did a collection of bourbon. Anything that can be donated to charity, we have the team that are able to provide the qualified appraisals, which result in the Form 8283, obviously what we're talking about today. Then on the gift annuity side, a real focus of ours, the non-cash piece and gift annuities are real 2 areas of emphasis. We do charitable gift annuity risk management. So we have 2 actuaries on staff. We do stress testing on typically large gift annuity pools and particular concentration of risk, cash flow projections, really risk management to make sure that the existing pool is being managed in the best way possible, and going forward, hopefully, can very confidently sort of bring in various types of gift annuities that are all incrementally positive to the sort of final net benefit, if you will. To some extent, that involves reinsurance design, in particular for larger cases, at sort of at what level, and brokerage and design, and working with carriers to have those placed. So we did a lot of that activity last year. And then the National Gift Annuity Foundation, that is an outsourced provider only for gift annuities. So we're the largest independent platform now in the country. We are in all 50 states. That was just a joy. And we got about, I think it's as of yesterday, or actually, yeah, it was yesterday, we did a firm meeting, and I think it was 642 contracts we have now, and about $53 million in assets. So if a charity, perhaps on the phone, or a client of an advisor on the phone here today too for the webinar, is saying, look, we're in a particular state, but we're not registered in this other state, we're going to have to say no. Don't say no. You can refer it over to our foundation, and there are others that do this as well, certainly. And then 100% of the residuum is passing back to the charity or charities that the donor was trying to give it to in the first place. Same thing if it's a gift of real estate for. We're actually doing one right now as of Friday where it's $250,000 of hogs, like hogs. Can't make it up. So that's the process. Ryan worked on one that was cryptocurrency last year, sort of got it designed. It did never go through. And so S-Corp stock, anything that's more complex, and or if the charity is saying, look, we're a really small charity, we don't want to do gift annuities at all, but we don't want to say no to some of our good donors, same thing. Then they can sort of outsource that. We manage the asset liability and so on. Same thing on the non-cash side. So it's very much the bulk of what we do. We have multiple entities. I think we're up to 15 single-member LLCs. I think that's right. So we have Decamai Foundation, which is a national donor-advised fund. I set that up in 2003, and it does nothing but take in illiquid or complex gifts. That's it. That's all we've ever done. That's all we're ever going to do. Only for those gifts that are otherwise being declined because the charity is unable or unwilling to accept the gift directly, and so they can refer that over to us. We have lots of evil competitors, and they're all super nice too, so we're not the only ones doing this. But we're really just a pass-through, donor-advised fund, following all best practices, all policies. But then we are able to take in that real estate, that business interest gift, such that then the donor's getting the full deductions. We then manage it. We're on chain of title. We do what we call the sausage making. And then once it's actually liquid, then we grant out all of those proceeds less a fee. So I've got a little one slide I'll talk about for about 3 minutes after this, probably 2 minutes. But that's what we do. We also do direct consulting where the charity might say, look, we can take this in ourselves, but we need a little bit of help with step 4 or step 8 or steps 8 through 12. We do it anyway, so we just charge an hourly consulting fee for those charities to help them through whatever part of the process that might be. So as part of the Decami Charitable Solutions side, we've got a team of 25 total. That sort of includes the appraisal piece as well. So all, most importantly, to help make gifts happen that otherwise wouldn't, primarily through risk management. So if you have a good donor with a good asset wanting to do good things, don't say no. We can potentially help. So the next slide, again, take about a minute. This is at least what we did for last year. The biggest part of all these numbers is the top in parentheses. 100% of these non-cash gifts were declined by the referring charity, or we never would have received the referral. You can see there we completed 261 donations in 2021. Ryan and I both know, he'll have less hair soon. Each time he does this, he'll have a little bit less hair. That we did about 1,900 referrals. So weirdly, it's about 8 to 1. So 8 referrals for every one that actually closes. But of the one that closes, that was the 261. You can see there was just under $1.2 billion in value. It's chunky. 100% of which for 2021 were declined. Then we sort of deconstructed that a bit. You can see real estate, 61 of those, 42 million. You can see the business interests. We then break out the business interests. S Corp is correct but not correct. A lot of LLCs elect to be taxed as S Corps that we would have in the LLC chunk here. But in most of those cases, that's probably my guess, maybe 40, 45 of the S Corps. And then so it was about equal between C Corps, S Corps, and then LLCs and LPs. You roll those up, it's about 1.1 billion. Cryptocurrency, so many calls. 37 that were actually completed. Maybe of the 1,900 referrals, like 1,800 probably cryptocurrency. That's a joke, but it's probably pretty close. And so that's 37 and about 28 million. And so one thing I always say, this is not a joke, 4 to 6 times a day, tell us about cryptocurrency. You've got a donor asking, boards asking, advisors asking. It's less than 2%. 2% of everything we did last year was in crypto, 98% in real estate and business interests. But 90% of our inquiries have been around the crypto side, so that's the new shiny thing. We get it. Cash, we don't do zero with cash. We do nothing with publicly traded stock, nothing with any kind of more liquid funds, all things being equal. So now transferring this over to Ryan, for all of these donations that we did, this is separate and distinct from the appraisal side. We're dealing with the 8283s and the 8282s. So we hope is that this can be an informative session, the questions, myths, and mysteries around what we see and stuff that actually keeps us up a little bit at night, where I'm asking Ryan, do you know how this works? I have no idea how this works. He's like, I think this is how it works. Let's talk to somebody else on our staff. So hopefully some things that we can illuminate that can help you. Many advisors on the call today, I know, and charities best sort of navigate these two-page forms. Should be simple. But Ryan, take it away.
Yeah, thanks, Brian. So just to start with a quick agenda of what we're going to talk about today. First, just taking a look at the actual forms themselves. Everyone on this webinar, I'm sure, has seen them, but just as a refresher to whip through, and we might need to flip back to them later, depending on some of the questions and the conversation. Then looking at mysteries related to the 8283, followed by the 8282 specifically, and then kind of general questions that might have to do with both, or just charitable policies towards appraisals and things of that nature. An important disclaimer there, we have this at the bottom, we always say this, please do check with your advisors for any information in this webinar. Obviously, this is a heavily tax-centered webinar, maybe more so than normal. Please don't sue us. And also, just a personal disclaimer, I'm shaking off a bit of a cold. It was a lot worse on last week's webinar. Hopefully it'll be okay this week, but please do bear with me if I start coughing. So with that said, diving into the Form 8283, like I just mentioned, I'm sure everyone is familiar with this form. This is the first page of 2. Section A at the top, that tends to be what I think of at least as the easy part, probably because we don't really deal with it that much in our work with Decami. That's where you're seeing publicly traded securities reported and smaller donations of property under $5,000 all being reported and claimed in that section A. Section B at the bottom, and then continuing on to the section of the second page, that's where we tend to see the most questions, the most most items filled out, all in section B, and continuing on to the second page. Section B, part 1 there, this is a tripping point pretty often for donors. They'll send over the 8283 and assume that we as the charity are going to fill that out for them. We never do that. First, we can't be doing tax work for donors. Second, even if we could, it has some items like the donor's basis, the date of acquisition for the donor. We never or very rarely have that information on hand. We may not even have what the appraised fair market value is, let alone what the donor is actually claiming as a deduction. So donors will send that to us thinking that we can fill it out for them, and we just have to send it back. The second page of the 8283, another common problem or mistake is donors thinking they need to fill out part 2 and part 3. Part 2 is very rarely, at least for us, something that needs to be filled out by donors because it has to do with partial interest donations. I would say I see it mistakenly filled out probably 4 times as often as I see it correctly filled out. Donors just see it there and assume they need to fill it out. Same with part 3. Donors assume they need to sign. They usually don't. Part 4 is where the appraiser needs to sign. One common mistake there is the identifying number. Appraisers see that and they assume that the IRS means their state appraiser license number, which is a kind of a reasonable thing to assume, but that's not what the IRS is looking for. They are looking for a tax ID number, whether that's the EIN of the appraisal firm, or sometimes if the appraiser is a sole proprietor, sometimes it does just mean social security number. That's what the IRS is looking for there. So that's a common mistake. Another thing I've run into with yeah, go ahead, Brian.
Even to jump in here,
yeah,
an appraiser on our team, Russ Willis, actually, I think, and not to put words in Russ's mouth, but I think he was even looking at it very deeply. That said it actually is supposed to be the EIN and not the Social Security number. And so we definitely see some appraisers using their Social Security number. But Russ actually said, you know, the more that he looked at it, it seemed fairly compelling. And again, nothing, as Ryan said, nothing we're giving you here is tax advice, so do your own research. But it actually compelled Russ to go forward, actually creating his own LLC to have the EIN, then to use that for the for this identifying number. So you can see right out of the gate, this is just not an intuitive sort of document.
Yeah, and from a practical standpoint, it makes sense because if the appraiser doesn't have an EIN and they have to put a tax ID in there, do you really want to be sticking your Social Security number on someone else's tax form and have that number floating out there in someone else's tax records? I can understand why an appraiser like Russ or really any other would not be too keen on doing that. So that's something that donors, their CPAs and appraisers certainly should keep in mind. Another thing I've seen is, and this goes to the first page, that section B, part 1, where the information about the donated property is supposed to be included. There have been instances where donors have not filled that out and sent it to the appraiser to sign. And I have seen more than once an appraiser who flatly refuses to sign without having that info filled out first. And that's certainly, I'm not an appraiser, but I would guess with pretty strong confidence that that's the best practice there. The appraiser doesn't want to be signing off on a blank tax form where the donor could mistakenly add a couple of zeros and get a much higher deduction than they're really entitled to. That's something else to keep in mind as well. And then finally, part 5 at the bottom there, donee acknowledgement. Of course, that's where the charity signs. And really that is the first instance where we see the related use item come up, the related use question. That's something that is really a point of emphasis for the IRS. And you can see that particularly on the Form 8282, which I'm going to flip to in a second. But even on the 8283, there's a question, does the organization intend to use the property for an unrelated use, yes or no? Always tough to know how to answer that. Brian, I don't know if you want to add any comments on that, or if you want to save those for later, but that's always kind of a sticking point, is should that be yes or no when the donated property in question is not tangible personal property and is not subject to related use rules? It's never been clear to me.
Yeah, to me either. And I know that there have been a couple of attorneys like, oh, it seems to be clear, typically it's no, but it is kind of one of those like really weird, it's such a horrible example, but it's like, have you stopped beating your dog kind of a thing. It's like you say yes, that's bad. You say no, that's bad. And so it's kind of the same thing where we don't deal with much on the tangible personal property side at all. So typically this would not otherwise apply, but it's still there and it doesn't sort of distinctly say that. So you get in, let's say, a closely held C corporation that you're going to sell, as an example, or cryptocurrency that we're clearly going to sell. And then so when we're acknowledging this, it says, does the organization intend to use the property for an unrelated use? It's like, well, we're not using the property at all. So how do you answer that? No, which means it would seem that you're intending to use the property for a related use, which we're not doing. Or you say, yes, we are planning to do that, but that's not the case either because we're not using the property at all. So typically we'd see that sort of as a no, obviously, but that does create some interesting triggers, in particular as it relates to the tangible personal property side.
Yeah, and tangible personal property is something we really see a lot of on the 8282, not so much on this first page here, but on the second page, which I'll get to momentarily. The first page is rather straightforward as far as IRS forms go. At the very top of it, your charity as the donee, that's your information, including the EIN. There, the IRS is specific. Then below that, information on the original donor and the successor donor if your charity is making some kind of in-kind grant. That's pretty rare for us. I don't know about everyone else on this webinar, but not too often that we have to fill out that part of the form. But you do need the donor's information there, particularly, again, their tax ID number. In this case, certainly that's going to be social security number more often than not, although sometimes you will, of course, have EINs when the donor is contributing through a trust or an LLC, or maybe even through an operating business that has its own EIN. And then in part 2, info on previous donees. Again, rare for us to have to fill that out. Usually the only time that would be happening is if we're receiving a donation from typically a private foundation, the sort of the family foundation winding down, needs to get rid of its assets and is moving some to a DAF. That's when we would be filling out that part 2 at the bottom of page 1 there. And of course, just as a reminder, this form needs to be filed within 125 days of sale. But as I flip to the second page, what does sale mean? That's a big question, because 125 days within sale seems simple. But this is kind of where the rubber hits the road and things start to get complicated with the 8282. Because does a sale include if it was a business and the business had an asset sale? So you as the donee charity might still hold the stock, but the stock is no longer in an operating business. All of the assets of the business have been sold. Does that trigger an 8282 filing requirement? It's not clear. What if there is an escrow or earnout or rollover stock received? How is that accounted for and reported on the 8282? Not clear. And there's even a reference here, and I confirmed this last week after the first webinar with our outside CPA. There's a reference to an exchange of donated property. The IRS doesn't seem to define that anywhere. So what an exchange means is not clear. And then to the right of that, questions 2, 3, and 4 in part 3. Again, here's more questions as to related use for tangible personal property donations. Question 2, interestingly, goes to partial sale. So in the cases where you as the charity have only sold part of the donated asset, maybe you are checking yes there, even if it's not tangible personal property, which is what question 3 and 4 drilled down on more. But again, it's a real point of emphasis for the IRS here. You can see in those questions, and then skipping down to part 4, that's all about tangible personal property. So the IRS is clearly paying a lot of attention to that. At the bottom, that's normally where the charity signs, of course, to attest to the sale. And kind of in the middle there that I skipped over, simple dates of receipt of the donation, date of sale, and amount received on disposition, just the nitty-gritty, the details of the sale. Although, again, what does sale mean? Maybe not as cut and dry as you might think.
And Ryan, how about maybe speak to the sort of that amount received upon disposition? So I get this question a lot, and they're like, well, is that, let's make up, it's real estate. Is that the net amount that is received at the time of settlement? Is that the net amount perhaps that's received, but then there's some kind of escrow or tax holdback that might be released in the future, but even though you haven't received it directly, you may in the future, or some kind of earnout? So maybe speak to that that line.
Sure. Yeah, so our approach has always been, and I think this may be backed up somewhere, although I can't remember off the top of my head, it should be the gross amount received. So in the case of real estate, we're thinking about the contract price. You went under contract to sell the house in Malibu for 1.2 million, but you, as the charity, only received after commissions and expenses and county transfer taxes, you might have only received $1 million and change. You should be reporting the 1.2 million gross amount received there, rather than the million and change actually received. Similarly, for cases where it's a sale of stock and there might be some sort of holdback or escrow, those should be included to the extent that they're known. Of course, they're not always known, and that's something that one of the questions we address later is, what do you do when those amounts aren't clear or maybe subject to adjustment, which is more common than you might think. That happens in really a lot of deals. There's some kind of post-closing adjustment.
That can obviously have some impact to the extent, and this is a big leap here, to the extent that the IRS, the point in this is matching up the 82 with the 83, the 8282 with the 8283, that the qualified appraisal is going to be based on, in essence, the gross value or the fair market value as of the time. And so in particular with real estate, if you had, let's just make up a 10 or 15% swing, assuming that you even sold it at the full appraised value, there's a big assumption there, then that can create a pretty big delta between the 8283 and the 8282. Where instead, if the amount received upon disposition is assumed the gross proceeds, now you're going to be much closer, which in generally case is much more accurate relative to what the appraisal was. So that delta can be potentially problematic if the charity is not reporting it correctly.
And there was a comment in the Q&A that said, among other things, that their practice when they do have partial sales, which sounds like might be more often than we do, is to include some sort of addendum describing exactly what the situation is and what their understanding of future payout amounts is. And not to get ahead of ourselves in the presentation, but That's kind of our practice too, is sort of a good faith effort to do the best we can. So I was heartened to see someone else commenting that they're doing basically the same thing that we're trying to do, maybe more effectively than we are, but no, that was that was a good comment. So moving
And then
over
Ryan,
now.
before we leave the
of course.
8283 and 8282, I can't remember what we did last week, but did we discuss sort of the practical or issues on timing on sort of who does what when, or do we discuss that a little bit further in the slides? I can't remember, but like going back, let's say to the 8283 as an example on part 2. And so
Yeah.
the instructions basically say that the charity should sign first. So I think it's, correct me, Ryan, pretty clear that the charity is supposed to sign the donee acknowledgement sequentially prior to the appraiser completing the rest of the form. And so while that's clear, and I think I do both, which is where this gets weird. So as an appraiser, for example, on crypto, my big issue is I want to make sure that when it says there at the bottom, donee acknowledgement, that property described above was received on the following date, that I want to make sure that the date that I'm actually doing it, in particular for crypto, talk about volatile, right? If you're off by a day, that could easily be 5–10% difference. So I want to be able to see what the date was to make sure that it's matching up with what my appraisal is, typically first. But so from an appraiser standpoint, I'd love for the donee to sign it first. And Ryan has gotten into some nice but firm, debates about what we do from the charity side. Is I don't want to sign that without seeing that the description of the property actually does match what we received, number one. So otherwise, we're signing a blank form. And number two, and most importantly, we need this for our audit records. And so we want to have a completed form with the appraiser's signature such that when we complete, it finalizes the executed document that we then send back to the donor. Otherwise, I cannot even imagine if we 261 times a year completed the donee acknowledgement first, and now we're chasing 261 appraisers to say, hey, please send us the final copy, because if we don't have that, now we don't have backup for both our 990 as well as for our audit. So some of these get very chicken and eggy, where there's some things from a practical standpoint that Ryan mentioned that might be clear or not so clear within the instructions. But from a practical point of view, it may not work that way. And so, in essence, both parties are accurate in terms of them saying, no, I want you to sign it first, and going, no, I want you to sign it first for other reasons.
Yeah, and Brian, there was a question in the chat about a safe delta between appraised value and sale. And I know that we've never really had a good answer to that, because the IRS tends to play that pretty close to the vest. But I've also never seen a donor, not to say it couldn't happen, but I've never seen a donor get in trouble because of a difference between the appraised value on the 8283 and the sale value on the 8282. And we try to keep those close when we can, and donors usually do too. But presumably there's at some point the IRS would pay attention to the difference. I just don't know at what point that is, where that that delta becomes unsafe, to go to the question.
Before I die, I want to know that as well. I don't know what it is. and there are people on this phone like, oh, I know, I want to know what the meaning of life is. I don't care about the meaning of life. I want to know what is the delta that triggers an audit off the 8282. That's all I care about. So I've not seen that come up. What I have seen clearly, and many on the phone have seen too, is where you, under IRS audit, will have a sophisticated field agent look at the 8283 and then pivot based on, was this a qualified appraisal, having all 13 elements, and is this a qualified appraiser, and basically does the appraisal itself take the appropriate methodology or comps or anything else to create fair market value as of the date donated. So that's usually the issue, less about the 8282 piece so far, but I mean, let's be honest, a third grader could create a computer program that said if A is more than 22% of B, spit it out under audit and flag it. I mean, that is not a complex programming task. But long-winded way of saying I have not seen anything. And in fact, I've worked on a case where it had about a 40% drop 8 months later on a very, very large case. It was post-2011. It was back in February, it was worth X. And on September 21st on absolute auction with North Georgia vacation property, it was worth 40% less than X, which became our 8282. At that point, again, that was a long time ago, that did not trigger any kind of audit or anything. The key is, was it the value appropriately defined as of the date of the donation is the key.
All right, yeah, thanks, Brian. So some good questions coming into the chat and to the Q&A. We'll try to get to those. So flipping over to mysteries about the 8283, the first one here, I think I was just thinking is really more of a myth. Donors believe in the common situation where rather than donating real estate by way of deed, they own the property in an LLC. Usually it's some kind of investment property, commercial real estate, and they just transfer the LLC to charity. They reasonably believe that they can just get an appraisal on the property itself, use that to substantiate the tax deduction on the 8283. Of course, the IRS does not like that. They need to see an appraisal of what was actually donated, which was the LLC. So thankfully, a sophisticated real estate appraiser is going to be able to handle that. And for these types of properties, usually, especially if it's commercial real estate, the donor is hiring an MAI certified appraiser anyways. But it's an easy way to get tripped up. And I believe the IRS has been making that something of another point of emphasis where they want to see an appraisal of what was actually donated, not the underlying asset, whatever that might be. Usually it's real estate, but it really could be anything. So something to keep in mind there is if donors are contributing a wrapper LLC that has some underlying asset, appraisal has to be on that LLC. Second mystery here, if a donor is making several donations of, say, Bitcoin during the same tax year, and all of those donations are under the $4,000 mark, under the $5,000 mark, say they're $4,000 each, is the donor required to get an appraisal? IRS is pretty clear on that. Answer is yes. And even if it is a donation to different charities, it doesn't matter that these were separate transactions, separate donations. The IRS considers these to be similar items. And so then that qualified appraisal requirement is triggered. Now, Brian threw in a sub question here, I think just to drive me crazy. What if it was 3 donations of Bitcoin and 3 donations of a different cryptocurrency like Ethereum, all valued, again, under that $5,000 mark, but in aggregate well over? Is the qualified appraisal requirement triggered? And that's not clear. Then the question really becomes, are different types of cryptocurrency considered similar items for the purpose of the 8283? I would tend to guess that they are, and that the donor is really better served playing it safe and getting a qualified appraisal. However, if the IRS is going to argue that they're similar items for the purpose of the 8283, they're kind of arguing against themselves, because they've been clear in saying that cryptocurrencies of different types do not qualify for a like-kind exchange. So they'd have to be arguing, on the one hand, cryptocurrencies of different types are not like-kind, but they are similar items, and that seems pretty inconsistent to me. But again, this is the IRS we're talking about, and for the individual donor, maybe it's better just to pay for the appraisal and play it safe. Other questions, is a donor required to have an appraisal for every non-cash donation over $5,000? And this is an easy one for me personally to get wrong, because we deal with non-cash donations every day, and the default assumption is non-cash donation. To get a deduction, you need to have an appraisal, always, appraisal. Technically, that's not the case though, right? There are about half a dozen categories of exceptions for assets that do not require an appraisal, let alone the fact that an appraisal is only required if the donor is itemizing and claiming the deduction. If they're not doing that, then they don't need to get an appraisal. Why would they? The categories that are exempt from the appraisal requirement, non-public stock under $10,000, so the threshold is a bit higher in that case. Intellectual property is exempt. Vehicles can be exempt as well, and then there's a few other categories that are even more obscure. So just something to keep in mind. Almost always an appraisal is going to be required over $5,000, but technically not every time. And then an interesting one in the next question, because we see this pretty often, if the donor has various acquisition dates and various different cost bases for a donation that's being claimed on Form 8283, is it enough for them just to write in various? And will the IRS accept that? Sort of. The IRS says that a reasonable explanation must be provided if the donor is not able to provide the specific acquisition dates and the specific cost basis information. There has to be some sort of explanation there. And so it looks like they're basically just looking for a good faith effort to explain why that information cannot be provided. However, a note there, because the IRS, on the other hand, has disallowed charitable deductions entirely purely on the basis that the basis wasn't included on the Form 8283, and there wasn't any kind of explanation. So there was a semi-recent tax court case, RERI Holdings, LLC, where the service denied the deduction because the basis was not included. The taxpayer took it to tax court, tried to make a substantial compliance argument, and the tax court ruled in favor of the service. There was a similar case a year later. In that case, the taxpayer actually did include an explanation, but they basically said, well, the basis doesn't matter for the deduction. That explanation was not good enough. So we have a couple examples here where the service is interpreting their rule requiring basis information to be included on the 8283. They're interpreting that rule very strictly, very literally. Now, both of these cases, I think, were somewhat suspect in the way that the gift was structured. Certainly RERI was. So maybe the IRS is being a little bit selective in the way that they're applying their requirement of including the basis on the 8283. But clearly, in both cases, the taxpayer took the IRS to tax court and the court sided with the IRS. So when that rule is being enforced, there's not a lot of wiggle room. And so donors should be very careful and think very carefully about whether they're going to include the basis and what sort of explanation they're going to include if they're not.
And Ryan, one thing that I see often, especially on crypto with how much it's been going up of late, is that they will include the date range from an acquisition point of view. And then the other issue is, how are they tracking basis on various lots? That's a whole other discussion for another day, whether that's basically like a share ID method or average cost method. But when they actually have the acquisition dates around a range, typically the 8283 will allow the month and the year, and then you can sort of range it that way. But I've just had two in the last 2 weeks where the person said, I started acquiring some of this particular token in 2020, and I completed that by sort of mid-2021. Well, the donation was in December of 2021. Now you've got a whole other issue because now you've got basis for different tranches, and one tranche would be long-term capital gain, acquired more than a year and a day before the donation. Other ones were short-term gain. Now you have issues of how you parse that out on the 8283 about the long-term gain portion and the short-term gain portion, and then obviously that then goes to the deduction. So very often people will put on there, again, just various acquisition dates, but the IRS, I'm clear, is saying, well, how does that help us determine whether or not this is long-term gain property or not? So that's a whole other issue.
And then to move in a different direction from really a crypto focused question, because like Brian said, that crypto is where you see the various acquisition dates most often. But to move to a different type of difficult property, international real estate, usually international stock is not as difficult to appraise, but international real estate or tangible personal property that's located overseas, how are the appraisals and compliance even handled for those sorts of properties? What we have cobbled together, I suppose, over time is the idea of having a local appraiser who would likely otherwise be qualified, but for the fact that they're located out of the United States, that local appraiser does the appraisal, and then a United States-based appraiser then signs off on the 8283, endorses or blesses, or however you want to frame it, the work of the local appraiser, and says this would be up to US standards. That's the approach that we've kind of developed. It is very challenging in that case, because with real estate, with tangible personal property, the physical condition of the property is essential to the valuation. So that it really is necessary to have someone who can physically inspect the property in most cases when it's an international piece of real estate or tangible personal property. Moving to the 8282 now. We talked about this a little bit already, so I'll just go through this first one very quickly. How does the charity handle partial sales or unknown future proceeds? Partial sales, there is a space to indicate yes or no if it was a total disposition of the donated asset. So if it's a partial sale, then you can say no, it wasn't a total disposition. But unknown future proceeds, things like escrow releases, any release of a holdback, earnouts, rollover stock, how are those disclosed or reported on the 8282? Best practice is probably to include an addendum, as was mentioned in the Q&A already. But it's not clear exactly what the IRS wants to see there. What should the charity do? And this goes to another question that was asked. If a donor demands, asks, or hints that the charity hold the asset for at least 3 years before selling, of course, that 3-year holding period, once that's expired, the 8282 does not need to file. If it's a donor demand, well, that looks a lot like a conditional gift, in which case it's an incomplete gift and there would be no deduction. The donor may be getting themselves into more trouble than they realize, even if your charity is willing to entertain such a demand. And that kind of goes to the softer requests of the donor ask or the donor hint that the charity should retain the asset for at least 3 years. It really goes to the charity's policies. Are they willing to do something like that in general? And are they willing to do it for this sort of asset specifically? Is it the kind of thing they would want to keep or even consider keeping for 3 years? That depends. What happens if the charity stops using tangible personal property for the exempt purpose? That is a complicated question. In some cases, the donor may have to recapture the fair market value deduction. It does depend, I think, in large part on the donor's good faith belief that the charity was going to put the property to a related use. And so the IRS, I think, is a little more friendly to the donor position there. If there was some good faith reliance on the charity's representation that it was going to put the property to a related use. However, the charity does need to attest to that on the Form 8282. There is a space where they have to certify that the related use became, quote, impossible or infeasible. Now, what does infeasible mean? That's not clear to me. And we don't deal with enough tangible personal property donations where we would probably ever encounter this situation. But if someone watching this live has run into this situation before, please do let us know in the chat or Q&A. I'd be curious to see if anyone watching this right now had encountered that situation before. A couple people raised their hands, so I'm guessing they have. Yeah, let me know, please. And so here are, as we move closer to wrapping up here, a couple questions that impact both forms, the 8282 and 8283. What happens with non-compliance? Well, it depends on who is not complying. The donor not complying with the requirements to file the 8283, as we've already discussed a bit, that's disastrous. That's a real problem. They are probably looking at no deduction at all in that case, which is a really, really bad outcome. Weirdly, what happens for charities when they don't comply, that doesn't seem to be as bad. The penalty for not filing or incorrectly filing the Form 8282 is just a $50 penalty. And so that seems much more lenient. Although if a charity fell into a pattern of non-compliance, I would imagine that the IRS might bring the hammer down in a more meaningful way. But I've not heard of any cases like that. What if the donor is not a US taxpayer or wants to remain completely anonymous? The short answer is they're probably going to have a hard time getting any kind of tax benefit. The simpler case is the anonymous donor. If the donor is anonymous, the charity cannot issue a donation acknowledgement letter. Donation acknowledgement letter is generally required to claim the deduction. So without that, the donor is not going to be able to get any sort of tax deduction or tax benefit. If the donor is not a US taxpayer giving to a US charity, it's tricky for them to receive a deduction as well. Maybe not impossible. If the donor is living in a country that has some sort of tax treaty with the United States government, it may be that there is some sort of reciprocity where a donation to a US charity does receive some sort of local tax benefit. Although in most cases, the foreign donor is probably better served finding the offshore equivalent of a Friends of org to do the donation, similar to what we often recommend or suggest that donors do when they're US taxpayers trying to give to a foreign charity. So tricky in both those cases to get a tax deduction, whether it's a foreign donor or an anonymous donor. And then to wrap this up, this is the final slide, bonus questions here. The first one, and this is the one that Brian alluded to that he and I were discussing earlier today, if the donor doesn't complete the 8283 for whatever reason, does the charity still have to complete the 8282? I had always thought so. Brian mentioned that he had always thought so. But as I was reading through the instructions to the Form 8282, there was an exception that the IRS listed, which seems to suggest that the charity actually doesn't need to complete the Form 8282 if the donor has not completed the 8283. I've got the text quoted below that new edition for today's webinar. But I think the point to focus on is the IRS example there, where they're saying, if the charity does not receive the Form 8283 until after the date that the donee charity has disposed of the charitable deduction property, they don't need to file the 8282 until such time as they get that 8283. It would seem to follow, at least to me, that if the charity never receives the 8283, they would never need to file the 8282 based on what the IRS is saying here. The beginning of that quote says, if the organization did not file because it had no reason to believe that the substantiation requirements applied to the donor. Well, yeah, if the donor is not filing the 8283, does the charity then not need to file? That seems to be what they're saying, at least as I'm reading this. What documentation should the charity keep from the appraisal, if any? That's a policy question. And for us, we've been reluctant to keep appraisals on file to the extent that they include donors' personally identifying information. So that's been something that we've tried to avoid when we can. But your charity may feel differently on that. Related to that, should the charity require an upfront appraisal, with the idea being that they would then know what the value is, and can proceed accordingly with the donation in general, and can book it at an appropriate value. We don't have that requirement. We've tended to rely on the donors' good faith estimates at the time they're filling out our donor advised fund paperwork, and use that as an initial value. And then typically when there's a sale, we would just update the value based on the sale price, or if it's a longer term hold, if there is some kind of later appraisal related to the 8283, or if it's say a private company stock, if there's a 409A, later funding round, those sorts of values we've tended to rely on as well. And then the final question here, and hopefully we'll leave a couple minutes for questions in the chat and the Q&A. Can the charity pay for the appraisal? And if so, what are the implications? I think technically nothing forbids the charity from paying for the appraisal. However, if the charity does, they're providing a benefit back to the donor, so that needs to be disclosed on the donation acknowledgement letter with the value of the appraisal, the cost of the appraisal, I mean, and that would reduce the donor's deduction. And practically speaking, for a charity, it seems like a bad idea to get in the middle of that, because donor typically wants to have the direct relationship with the appraiser, wants to be the client of the appraiser. And I've always thought it's a bad idea. If the appraisal doesn't look good to the donor, does the charity really want to get in the middle of that? Do they want to say, oh, charity, you hired this appraiser, you picked this appraiser, and they gave me a crummy value? That's a situation best avoided. And I think the easy way to do that is just to have a policy that says the charity will not and cannot pay for the donor's appraisal for 8283 purposes.
Totally agreed. I would say of all the appraisals that we do, probably 99% are paid for by the donor. It's the taxpayer's responsibility to substantiate the charitable deduction. And so for the 1 or 2%, honestly, it's just so much back and forth with the charity and the donor and so forth. So Ryan, not able to see your screen now. You might have dropped off. I'm not sure. Well, we're almost at the end anyway. The only other point that I was going to make is to be careful, or at least cognizant, when you're reviewing the 8283 and 8282. I've made this mistake myself, and I do appraisals all the time, that there is a version number and when it's revised. As an example, the 8282, I'm almost positive, is 2009 was the last revision of that. New version, last revision. Say that 5 times fast. And for the 8283, I want to say it was December 2020. And then so technically, any of those revisions are due timely, so that if you're using one prior to December 2020 as an example in the 8283, then generally that will not conform. So lots of nits and gnats certainly in this space, to be sure. So with that, I know we have some Q&A that we were not able to get to. I think we got a minute or two left, but I want to be able to first thank Ryan again. I think he dropped off at the perfect time, by the way. And the second thing is we will be taking all the Q&A from last week's webinar, all the one from this one, and the chat, sort of mushing them together, and then that will come out as part of the link again for this free webinar. So if you haven't gone to our website, charitablesolutionsllc.com, under resources, we have about 20-25 different webinars. So one thing just on appraisals, and obviously this is a component of that for the Form 8283, and we've done some on NFTs last month and so on. They're all free, access them anytime, as Ryan's jumping back in, it looks like. So we're going to send that out again toward the end of this week or first part of next. So it'll have that link and then the compilation of the Q&A too. So I think we're good, Ryan. I think I handled it okay while you dropped out. Are you able to maybe just share your screen? You can at least show the last webinars that people can access for free too for a minute or two, and then we'll wrap it up. But I think we're in good shape. The point was, as we talked about at the outset, is there are some things that are pretty clear based on instructions, and then things that you think would be clear in terms of terminology are not clear, or they're super clear 80% of the time, and the other 20% of the time you're thinking, I have no idea what we do here. And we deal with that all the time. And so I always sort of go back to an 8023 is a super simple 2-page form until it's not, and the 8022 is a super simple 2-page form until it's not. And so it's amazing how much detail and perhaps strategy and just murkiness is involved, or at least for our donations. Again, we did about the 261 last year. That was about $4 million per donation. So it's $4 million of murkiness that you're on these forms. So this is not, oops, we're, over or under by $15. These are major type donations that otherwise, if they're not fully substantiated and then fully reported from the charity side, can obviously have some not good considerations or circumstances for them. That's okay. It looks like, Ryan, you can't pull yours up. No big deal. So we're going to go ahead and close it out. I think we're right on time. I do hope everybody found this helpful. If there are any other future topics that you guys might have, we got the next 2 or 3 sort of lined up, but we always try to be responsive to attendees. Let us know. But other than that, it'll be coming out here into this week, first part of next, and then we'll go ahead and have our next topic for next month. So thank everybody for your time. Good luck.
Thanks all.